Hi, this is Matthew Cratter from Trader University, and today I want to talk about Brent Johnson's dollar milkshake theory. This is a theory about how the US currency is going to behave, and I know a lot of you have asked me about it. And I'm going to contrast it with my own theory, which is called the Bloody Mary dollar theory. So if you like milkshakes, if you like Bloody Marys, if you like learning about what the market's going to do, you're going to love this video. Please hit that subscribe and like button if you're interested in learning how to make money in both bull and bear markets. So the dollar milkshake theory was basically developed by Brent Johnson, as we said. He runs Santiago Capital, which is based out of San Francisco, where I used to work. I don't know him personally, but I've been reading up on dollar milkshake theory over the last few months, and I know a lot of you have asked about it. So it's basically a theory about how the US dollar is going to go up a lot over time. Brent Johnson, according to his tweets, according to what I've been able to gather online, believes that the dollar index, which is the DXY, this is the US dollar measured against a basket of other currencies such as the yen, the euro, Canadian dollar, Australian dollar, Swiss franc, etc. He believes this is going above 150. Now, to put that in perspective, 150 is something way up over here. The last time the US dollar index was even in the 130s was in the mid 80s. And at this point, all the countries, all the major economies got together at the what's called the Plaza Accords, and they agreed to massively weaken the US dollar. And ever since then, the dollar's been sort of trading in a range, certainly for the last 10 years, somewhere between, call it 88 and 104 or so. So his prediction is actually quite extreme. It's that the dollar will rally way up this direction. Now, I believe this is completely untrue, and if you trade according to this, you're not gonna be able to make money. That's why it's important to understand how this works. Raoul Pal, who runs Real Vision, really smart macro guy, has called the US dollar the global wrecking ball. And what you need to know, and we'll investigate a little bit more, is that when the US dollar rallies, especially if it rallies too high, it makes every other asset go down. This is simply because the US dollar is the world reserve currency. And so when it spikes, the US stock market crashes, global stock markets crash, commodity prices crash. It causes a lot of problems. And this is one reason I think that Brent Johnson is just wrong. There's no way that we can let the US dollar go very high. And as we'll see, the Federal Reserve can actually control the level of the US dollar to a huge extent. So why is it called the dollar milkshake theory? Well, thanks to Pinterest, here we have a classic vanilla milkshake. This is the metaphor that Brent Johnson's using. Basically, you have this delicious looking milkshake. You've got a lot of froth. It's a very frothy milkshake simply because this is bubbly asset prices. This is frothy asset prices. Stock market's high, real estate's high. All these different asset prices have been in a bull market for many years, really since the great financial crisis. We've had the COVID hiccup, which we'll talk about. But basically, you have this frothy milkshake of markets that's been created by adding central bank liquidity. This is the milk, this is the ice cream, this is the whipped cream that you add. And if you add a lot of this liquidity and you froth it up, you get very high PEs, you get crazy markets as we've been seeing. Now, what does this look like in terms of how do central banks create liquidity? Well, we can see here this is the Fed funds rate. This is the rate set by the Federal Reserve, the rate at which banks lend to each other. And this used to be in the 4s and the 5s. They slashed it basically down to zero in the wake of the great financial crisis of 2008, 2009. They kept it at zero for many years. And then in early, call it 2016, they began to raise interest rates. When you raise this rate, you push up a lot of other interest rates as well. You push up LIBOR, you push up all the interest rates that are associated with that, as well as other treasury rates. So they raised rates really from 2016 to 2019. So that's one piece of it. Low interest rates contributes to froth. The other piece of it is asset purchases. This is quantitative easing. This is what we're always talking about, where the Fed prints money, buys treasuries, buys mortgage-backed securities, even now buys junk bonds and munis. This basically didn't exist. It really was only in Japan until the great financial crisis in the US. And you can see that the Fed at that point started printing money, buying US Treasuries, trying to recapitalize the US banking system. But once the stock market recovered, once it was clear that the financial system in the US was not going to collapse in the wake of the housing bubble popping, they kept the asset purchases going. They kept quantitative easing going. And you can see that they really continued to raise their asset purchases, which adds liquidity, adds froth, until 2014, 2015. So these are the ingredients of the frothy milkshake. Low interest rates, quantitative easing, purchasing of treasuries, money printing. This adds liquidity into the system, makes the stock market go up, makes everyone happy. Now, what is the straw? Well, the straw is when the U.S. Central Bank, the Federal Reserve, began to suck out the liquidity. Now, this happened, we can see on the charts, when they started raising rates from 2016, as we said, to 2019. And at the same time, they started shrinking their balance sheet. And if we select this little period here, we can see that they were shrinking their balance sheet. They were basically letting these treasuries mature, these mortgage-backed securities mature, roll off their balance sheet. So they shrunk their balance sheet from about $4.5 trillion by the bottom down to about 3.7, 3.8 trillion. Now, the Fed had promised us, I remember Bullard in particular saying, the growing of the Fed balance sheet is just a temporary thing. Once the crisis is over, we'll shrink it. Well, in fact, they never shrunk it. They tried to shrink it, and when they were shrinking it in 2018 and 2019, it caused sort of a mini stock market sell-off. It was very bad for asset prices. And then what happened in the third quarter of 2019, as we've talked about many times, is there was a repo crisis in the U.S. Basically, the U.S. had been running these huge fiscal deficits, spending more money than they were bringing in, Congress. As a result, they need to sell a lot of treasuries, and foreign investors had really stopped buying on the margins. And so it was the big U.S. banks, those hedge funds that were buying these treasuries. Pretty soon, the supply of treasuries, the supply of debt from the U.S. government began to overwhelm the system. No one had balance sheet space for it. And repo rates, short-term rates, these overnight rates spiked. And as a result, the Fed was forced to begin asset purchases again. So this is the period of the straw right here, sucking out liquidity. But starting in the third quarter of 2019, the Fed was forced to begin adding more liquidity in an effort basically to monetize fiscal spending, to monetize the U.S. debt. So this is one problem I have with Brent's theories. Basically, this straw was taken away in the third quarter of 2019. I don't think they'll ever be able to bring it back. If they bring it back, it might be a tiny little thin straw. Now, as soon as the stock market realized that the Fed was done raising rates, that they probably have to cut rates, that they were buying treasuries, we had this real melt up in the third quarter, beginning in the third quarter of 2019, and really continuing into February of 2020. Then what happened? Then COVID hit, really out of the blue, surprised a lot of people. And we began to get the stock market crash, which we'll talk about. This virtually ensured that the straw for the milkshake was gone for a very long time. So what happened to the milkshake at this point? Well, in order to talk about that, we first have to very quickly review what the U.S. euro dollar system is. It's basically all these U.S. dollar deposits and loans and money, U.S. dollars circulating outside of the U.S. banking system. Now, what we got in the wake of the COVID crisis is what's called a liquidity crisis, where people panic, they flee into safe havens. They dump stocks, they dump commodities, they even sell gold. Obviously, they dump Bitcoin as well, and they're trying to get their hands on U.S. dollars. People inside the U.S. were doing this. People outside the U.S. were doing it. If you were dumping your stocks in March, you were playing along with this. Now, investors outside the U.S., central banks, companies, people involved in this Eurodollar system, they have a problem when there's a liquidity crisis or any sort of financial crisis. Because what happens is the US dollar spikes, the DXY, as we've been saying, spikes. Now, this is part of what Brent Johnson's talking about, but he's talking about it as being sort of a structural thing where the system is structurally short on US dollars. And so you'll have these panics where everyone rushes into the US dollar. And in addition to dumping stocks and dumping commodities, they also dump other currencies. They sell their euros, they sell their yen, they sell their Canadian and Australian dollars and try to flee into US dollars. Now, what happened in March of 2020 is that there was such a shock to the system that they actually ended up selling, especially foreign investors, ended up selling US Treasuries. This is the yield on the 10-year note, the US government bond. And we can see that from March 9th until March 18th, we had a big spike in yields. Yields moved from about 0.4% all the way up to about 1.3%. We had a huge spike in yields. This is because people, especially international investors, began to dump their bonds. If we look at IEF, that's basically the ticker for this. What we were looking at before was the yield. This is the price. When the price goes down, as it did here in March of 2020, the yield goes up. Now, why were foreigners, international investors, dumping their treasuries? Normally when the stock market goes down, the treasury market goes up. This is one reason they tell you to diversify between bonds and stocks. But there was a weird situation in March where everything was going down, even gold, even quote unquote safe haven assets like gold. Now, the reason was it has to do a lot to do with this Eurodollar system. All these people outside the US banking system, outside the US, they needed desperately to get their hands on US dollars in order to service their debt. So what you have outside of the US is you have a lot of loans between countries that don't even involve the US that are denominated in US dollars because it's the world reserve currency. Everyone wants dollars. So maybe the Chinese will sell some products to a country in Africa. They'll send them a bill in US dollars. They don't want their African currency. They don't want Canadian dollars for it. They want US dollars. So you have a lot of not only deposits outside the US, but also debt outside the US that needs to be serviced. Debt between corporations, between individuals, between banks, even between central banks. Now, normally there's enough US dollars outside the US circulating around because we have global trade, and global trade for the most part is conducted in US dollars, being the world reserve currency. If you buy oil, most of the time, I'd say 95% of the time, you have to pay in US dollars. Now, Russia and China have been trying to change this, but for now, this is what are called petrodollars. Basically, trade in most commodities, especially oil, is conducted in US dollars, as is trade in products and services. So normally you have these US dollars kind of flowing around the world, helping to facilitate trade, helping to facilitate the circulation of oil around the world, and used to service US dollar denominated debt overseas. But what happened with COVID? All of a sudden, everything ground to a halt. The global economy ground to a halt in most places due to the lockdowns, due to fear, etc., and due to lack of demand. If you're stuck at home, you're not driving your car, you don't need gasoline, you don't need crude oil, you're not going to the store, you're not buying cars, you're not buying houses. Everything ground to a halt. And so as a result, these US dollars that normally circulate were no longer circulating. And there was a huge US dollar shortage. That's when we saw the height of the liquidity crisis, when everyone was trying to get their hands on dollars and the price of dollars in all currencies spiked. This is traditionally what happens during a crisis. Now, Brent Johnson seems to think that it's going to happen even outside of a crisis, or that there'll be this continued crisis. But I'm going to show you in a minute why I think he's wrong. So people outside the US, and by people I mean corporations, individuals, central banks, foreign banks, etc. People needed these dollars to make debt payments, and they were also fleeing into dollars for safety. So maybe if you're in Brazil or Argentina or some African country, you begin to see that bad things are happening in the world. So you say, well, you know what? I'm gonna store up a few US dollars under my mattress. I'm worried that my local currency is going to be depreciated, and maybe if I need to leave the country, I'm not going to want to take my local currency. I'll just take a couple $100 bills, which are accepted basically everywhere in the world. And so people were desperately trying to get their hands on dollars. They drove up the price of the US dollar, and they also dumped treasuries to get their hands on dollars. Now, what happens when treasuries get dumped? This spikes interest rates in the US. We've talked about this already before. And higher interest rates are not something that the US economy can withstand. We're a highly financialized economy. We don't make a lot of things anymore. Basically, everyone's either doing software or is in financial services, it seems like. But we're highly financialized as opposed to an economy perhaps like China, where they actually have a lot of factories and they're doing manufacturing, etc. A lot of this is the result of just that we have the world's reserve currency. I'll link to my video from yesterday if you want to learn more about that. Basically, there's no way the U.S. economy can withstand higher interest rates. Because if treasury rates spike, that means mortgage rates spike, makes it much more expensive to own a home, it makes housing prices go down, you get higher car loan rates, interest rates, people can't finance their spending, so consumer spending plummets. And then simply because of the discounted cash flow model, stocks will fall as well, because you're applying a higher discount rate to future cash flows. This is how stocks are valued in general. So what happens? Well, what happens is the Fed jumps in. As we've always said, they're the buyer of last resort. When treasuries crash, when you have a repo crisis, when for every reason there are no buyers of treasuries, the Fed will step in and provide liquidity to the system. So the Fed started buying all the treasuries out there. Anyone who wanted to sell their treasuries could sell it to the Fed. And so the Fed was able to stabilize treasury prices, drive treasury prices back up. And what this meant is that interest rates came back down. So again, here's the March 2020 spike up in interest rates. Once the Fed intervened, they were able to get interest rates down again. We've had a little blip higher in interest rates as well, and now they've come back down again. And there's a lot of talk, as I've talked about in my previous videos, about yield curve control, where maybe the Fed never again lets interest rates on the 10-year get above 1%, for example. That'd be sort of a natural target. So the Fed started buying these treasuries in an effort to keep interest rates down and to basically take the treasuries off the hands of all these Eurodollar people who needed US dollars and were dumping US assets, especially treasuries, to get these US dollars. The Fed also opened up currency swap lines. So they basically said to the world's central banks, especially the big ones, if you need some US dollars to distribute to your country's banks or your country's people, you can just deposit some of your foreign currencies, send us your Swiss francs, send us your Canadian dollar or your euros, and we'll give you US dollars. We'll swap them for US dollars. And if you have a currency that we don't trust, well, just give us some treasuries to hold on deposit and we'll give you US dollars. So these currency swap lines are very important. They were first used, I believe, during the Great Financial Crisis in 2009. And since then, they've become a very interesting policy tool that the Federal Reserve uses. And so as a result of this, the Fed was able to bring the US dollar back down, weaken the US dollar. And you can see it's really weakened a lot in the last few weeks. But the part we're talking about is we have a spike in the US dollar, interest rates spiked, and the Fed was able to bring the dollar back down, avert a crisis by buying treasuries, by bringing yields back down, by providing currency swaps to all these international investors, central banks. Now, I believe this is why dollar milkshake theory is just wrong. As Raoul Paul says, a strong US dollar is a wrecking ball. It really blows up the whole economy. This is because the US dollar is the world reserve currency. And so we can never have any more US dollar spikes. It causes too much damage. And so whenever we get one, all the Fed needs to do is just print more money, buy more treasuries, open up more currency swaps, and flood the system, both the domestic system and the international system, the Eurodollar system, with more US dollars. Now, this is very easy for the Fed to do because, as Bernanke said, the Fed possesses a technology called a printing press. They can print as many US dollars as they want. The US economy is so leveraged. The global economy is so leveraged. If you look at debt measured relative to GDP, if you look at global debt measured relative to global GDP, we're at, I believe, all-time highs. The whole global financial system, which is really the US dollar system, is so levered that I believe that the straw is gone from the milkshake. At this point, the Fed can only really add more milk, add more ice cream, add more sugar, more whipped cream, and they're not going to be able to. Maybe they'll temporarily withdraw, suck a little of the milkshake out using their straw by letting their balance sheet shrink a little bit, raising interest rates. But it seems very unlikely. The opposite of using a straw is using yield curve control, where you basically say interest rates are not going up ever again, or they're not going up till 2022 or 2025 or 2030. And I think this is one thing the COVID crisis has shown us, that whether it's a pandemic or some other, it doesn't really matter what the pin is that's pricking the balloon, but we have this very leveraged system, and as a result, the US dollar can just not be allowed to rise. And there's no reason the Fed would allow it to rise. It's bad politically. It's bad for retiring baby boomers if their stock portfolios go down, if their housing prices go down. It's basically bad for everyone. So the only escape valve, the straw, you can basically throw out the straw from the milkshake. The only escape valve is the currency. The US dollar needs to be continued to be devalued. And as we said at the beginning of the video, when the US dollar goes down, commodity prices go up, global stock markets go up, everyone's happy. The only problem is if you're holding cash in your US savings account, if you're a retiree, you are getting, I'm trying to think of a nice term for it, but you are not being treated very well because those dollars in your pocket in your savings account are being devalued in an effort to prop up asset prices. This is the world that we live in. There's one more chart I wanted to show you actually, which is the TED spread. This is the ratio of basically euro dollar interest rates to domestic interest rates, the 3-month treasury. We can see during big crises, we get a big spike in the TED spread. The T is for T-bills, the ED is for euro dollars. And so it basically measures the relative demand for offshore dollars versus onshore dollars. And when you get a spike, let's just scroll in here. When you get a spike, as we did in March of this year, what it tells you is that there's a relative dollar shortage overseas in the euro dollar system versus at home. The chart looks basically the same as the US dollar index. It looks basically the same as the yield on the 10-year note. These are all related. But I present this to you as evidence that there was a crisis in the euro dollar system in March, that there was a huge shortage of dollars overseas versus at home. So this is why I believe dollar milkshake theory doesn't work. Instead, actually, I should say this. I'll link to I have another video on euro dollars if you really want to dig into it, and I go into much more depth. But this is why I'm proposing, instead of the dollar milkshake theory, I'm proposing the dollar Bloody Mary theory. This is Paul Krugman, one of the worst economists who's ever lived, who's had way too much influence in the U.S. economy. He basically told the government in the wake of the stock market collapse in the early 2000s, you need to create a housing bubble to fix this. So this is a great meme. Too much debt killing the economy. More debt will fix that. So this is the Bloody Mary theory of economics. That if you have too much of something, if you've been drinking all night, you feel really bad in the morning, the solution is to have a Bloody Mary, which supplies electrolytes. Unfortunately, it has more alcohol in it. So what it does is it just delays the ultimate solution of the problem. So I'd suggest that the U.S. economy has been in the financial system, global financial system, really staggers from being drunk to being hungover to more of the hair of the dog that bit you. And that's why I chose the Bloody Mary as my metaphor. So what are the ingredients of this Bloody Mary? Basically, it's money printing. And obviously, we don't have a physical printing press. These US dollars are created digitally. It increases the money supply. This is the percentage change from a year ago of the US money supply. If we look just over the last year, we can see that last year the money supply was maybe growing at 5 or 6%. All of a sudden, in the first quarter of this year, it was growing at rates of anywhere from 12% to 23%. Sort of stabilized here at growing at a rate of 23%, increasing the money supply. And they increase the money supply by printing more money. They use that money to buy treasuries, as we talked about. They use that money to buy munis and mortgage backs and even junk bonds. They use it also to open up those currency swap lines we were talking about. As a result, here's the Fed's balance sheet. We can see that this was the period of the straw here, where liquidity was being sucked out of the system. The straw is gone. We are now at the point where we are going to be drinking Bloody Marys 24 hours a day, 7 days a week, 365 days a year, forever. I don't think we can ever go back. This is the Fed's balance sheet spiking as they print more money, buy assets, and hold it on their balance sheet. Just to give you an example, this tweet from Zero Hedge this morning showing that the Fed has monetized all Treasury issuance in 2020. So basically, U.S. Congress needs money to spend. They go to the U.S. Treasury. U.S. Treasury sells debt. And our central bank, the Federal Reserve, has been buying all of this debt with printed money. So basically, you have a situation where the central bank is just printing money out of nowhere, creating money ex nihilo, and giving it to Congress to spend via the U.S. Treasury. This is the Bloody Mary way of running an economy, where if things are, if you're feeling bad, if you're feeling hungover, if you've had a crisis, you need to just have more of the hair of the dog that bit you. This is what money printing is. This is one reason I'm very bullish on stocks for the next couple of years. I'm very bullish on gold and extremely bullish on Bitcoin. Especially gold and Bitcoin will benefit from the Bloody Mary economy. These are very sober measurements, and they basically measure how much alcohol is being injected into the patient's system. The government can lie to you. They can tell you that the CPI rate is low, that inflation is low, that everything's okay. But when you see gold and Bitcoin going up, as they will continue to do, you know that not everything's okay. And if things are okay, it's just because the patient has recently had another Bloody Mary and has bought him or herself another 6 hours of sanity. But then 6 hours later, you're going to have another Bloody Mary. So that is my case for the Bloody Mary economy against the dollar milkshake theory of the economy. Hope you guys found this helpful. If you did, be sure to hit that like and subscribe button, and let me know your questions and comments in the comment section below. Hope you're all doing well, and look forward to seeing you in the next video.